Welcome to the Deep Dive. Today we're tearing apart the Q3 2025 earnings call for MINISO Group, ticker MNSO.
We're looking at the September quarter, the first 9 months, for this global IP-driven value retailer.
And our mission today is really to give you the shortcut.
Exactly. You've got record-breaking revenue, massive store expansion. I mean, the company is clearly executing on growth.
But the market's reaction, basically flat.
And that's the puzzle. We have to dissect why all this strong momentum didn't, translate into an immediate stock boost.
That tension is really why we're doing this deep dive. Management sounded what they called constructively bullish.
Oh, for sure. They were highlighting all-time high revenue, hitting that 8,000 store milestone.
But the market was just cautious. It suggests investors are looking past the raw growth and are really focused on profitability execution.
It's a classic case of a fantastic top-line story, but a more complicated bottom-line picture. We're going to unpack that complexity. The tale of two earnings, if you will.
All right, let's start with the good news then. The results snapshot. The revenue beat was pretty substantial.
It really was. Revenue grew 28.2% year over year.
Which comes to about RMB 5.8 billion, or just over 814 million US dollars.
And that number sailed past everything. It beat their own guidance, beat the analyst consensus by around 3%.
And this is the first time they've ever crossed that RMB 5 billion threshold in a single quarter.
That's a huge validation for their model, especially right now when so many other retailers are struggling just to find growth.
Okay, so top line is great. What about the bottom line?
Well, if you look at the adjusted number, the non-GAAP EPS, that also looked great. It hit RMB 6.64 or 93 US cents.
Which beat consensus by a healthy 6% and was up about 8% from last year.
So a clear beat on top and a clear beat on the clean adjusted bottom line.
But, and this is the critical point.
Yeah.
The headline number, the GAAP number, actually fell sharply.
It did. It dropped to RMB 4.36 from RMB 5.80 a year ago.
And that's a massive gap. It tells you right away that the operational story and the accounting story are, they're diverging.
They are. And we're going to have to isolate that noise later. There are structural changes from the expansion and then some one-time accounting items.
Before we get into the noise, let's just appreciate the scale here. The global store count is now over 8,000.
A huge milestone. And their adjusted operating profit crossed the RMB 1 billion mark for the first time.
That's a key point. Despite some margin pressure, the absolute profit engine is getting bigger and stronger.
Right. That 1 billion in adjusted op profit, it proves the flywheel is spinning faster and generating a ton of absolute cash. So let's drill into what's powering that.
Okay, deep dive 1. Operational acceleration and store strategy.
The core MINISO brand revenue was up a very solid 23%. They added 102 net new stores in mainland China.
But if you're looking for the superstar this quarter, you have to look at Top TOY.
Top TOY is the rocket ship inside the company. It delivered, truly exceptional triple-digit growth.
111.4% year over year.
Just think about that. A subsidiary growing more than twice as fast as the core brand. And they're expanding aggressively, too. 40 net new stores.
And it wasn't just about opening new locations. Their same-store sales growth, the SSSG, that accelerated pretty much across the board.
Group-level SSSG hit mid-single digits, which is respectable.
But the real story is in their established markets, right? The quality of that growth.
Absolutely. Mainland China SSSG was in the high single digits. Management called it high-quality growth. That tells you traffic is strong, basket size is up, it's healthy.
And the international story is fascinating here. Same-store sales turned positive overall.
But the direct operated markets like the US and Canada, they were achieving low double-digit SSSG.
That is a huge win in very, very competitive Western markets.
It really is. It proves the IT-driven value model isn't just a China phenomenon. It works here. And they said that momentum continued into October, by the way.
So the strategy seems to be shifting from just scale to quality and scale.
That's right. In China, they're upgrading their existing stores, not just building new ones everywhere.
They relocated or optimized over 200 stores in the first 9 months.
And this isn't just cosmetic. It's a unit economics play. These optimized stores are more efficient. The rent-to-sales ratio is actually declining.
So more revenue for every dollar they spend on rent.
Exactly. And they're launching new formats to back this up, like the MINISO Friends store concept.
Right, which is positioned more like an accessible luxury experience.
Yeah, they're moving away from that pure discount retailer image. They're getting better spots in the top-tier shopping centers.
Which brings us back to the core strategy.
IP-driven value retail. Think of it like a treasure hunt. The IP collaborations, they have 16 of their own artist IPs now that gets you in the door.
The cute character merch.
Right. But once you're in, you fill your basket with the core high-margin stuff, home goods, cosmetics, the things you come back for. It's interest-driven consumption.
Okay, which leads us directly to the big challenge.
Yeah.
The thing the market is fixated on. Profitability and those margins.
It is. The structural growth, especially that international expansion, is what's causing the margin dilution.
But let's start with the good part. Gross margin held up surprisingly well.
Yeah, 44.7%. It was only down 20 basis points from last year, which, given freight costs and everything else, is excellent.
However, the adjusted operating margin, that came in at 17.6%, and that's down 2.1 percentage points.
It is. And even though it improved from Q2, that year-over-year compression is the headline worry for investors.
Why? What's the main driver?
It's that structural shift we mentioned. The single biggest reason for the margin compression is the rapid and successful scaling of their international direct-operated business.
Okay, can you break that down? Why is that model less profitable, at least at the start?
So think of it this way. Historically, MINISO grew with a franchise model, especially in China. It's asset-light, like McDonald's.
The franchisee pays the rent, the labor.
Exactly. MINISO just sells them the goods wholesale and collects a high margin fee. It is margin heaven.
Right, but in the U.S. and Canada, they're running the stores themselves.
Precisely. That's the direct operated, or DO, model. Think of Apple owning all its own stores. MINISO now has to pay for everything. High labor costs, expensive rent in prime locations, depreciation.
It's an asset-heavy model, necessary for quality control, but it structurally dilutes the overall company margin.
It's a necessary evil for high-quality global growth.
Hmm.
But here's the crucial detail. The dilution might be stabilizing.
How so?
You have to look at the relative growth rates. The international DO revenue grew by almost 70% year over year.
Okay.
But the selling expenses for those same stores only grew by about 40.7%.
Revenue growth is way outpacing expense growth in that segment.
And that's the proof. It shows that operational efficiency is getting much better as those international stores mature. They're starting to scale properly.
That is a key distinction.
Okay.
Now let's hit the second type of noise that made the GAAP number look so bad, the accounting charges.
Right. And this is purely accounting cleanup. It has nothing to do with how the stores are running. Two big items.
What's the first?
High share-based compensation, or SBC. It was about RMB 176 million.
And that's tied to TOY, right?
Mostly, yes. It's part of their equity incentive plan as they get ready for a potential public listing. You see this all the time with high-growth subsidiaries heading toward an IPO. It's a non-cash expense.
Okay, and the second item?
A loss of about RMB 146 million related to an investment they have in a company called YH.
So if you step back, the market is punishing the stock for two things: necessary international expansion costs and temporary accounting charges related to the success of TOY.
That's it, precisely. And the ultimate proof that the underlying business is healthy is the cash flow.
Right. Despite all this noise, cash flow was outstanding.
Quarterly operating cash flow was almost RMB 1.3 billion. That's about 183 million US dollars.
And the conversion rate, I thought this was amazing. Their operating cash flow to adjusted net profit was 1.7 times.
Yeah. I mean, for every $1 of adjusted profit, they're generating $1.70 in real hard cash. That kind of resilience is stellar. It's what lets them fund this expansion internally.
So let's look forward then. Management sounded confident.
They did. They're guiding for Q4 revenue growth of 25 to 30% year over year.
And a full year 2025 operating profit in the range of RMB 3.65 to 3.85 billion. So the trajectory is still strong.
They did acknowledge some risks, though. Macro weakness, some social unrest in parts of Southeast Asia and Latin America.
But they believe their value model gives them some built-in resilience when, consumers get squeezed.
It should. Now, the strategic catalysts are what investors really need to watch for in 2026. And the big one is the planned Hong Kong listing of TOY.
That's the value unlock.
It is. Right now, TOY, growing at 111%, is just buried inside the main company. Spinning it off should give it its own much higher growth multiple. It's a huge potential catalyst.
And the second catalyst is just doing more of what works, replicating the U.S. and China's success in other countries.
And really focusing on getting those international DO store margins up. The market is waiting for that inflection point.
Which explains the stock's reaction. It closed flat the day of the call, despite all the beats.
But the volume spiked 4 or 5 times the average. A lot of debate happening. And look, the stock has lagged the retail sector and the S&P 500 over the past year.
Analyst targets are still implying, what, 30–40% upside? But the market is skeptical.
It's a show me, don't tell me situation. Investors want proof that those international margins are on a stable path up before they'll pay for the top line growth.
All right, that brings us to our "This is not financial advice" segment. Time to put on our contrarian analyst hats.
Let's do it. So the outrageous but plausible trade thesis here is pretty simple. Bet on the cleanup crew.
I like that. Exploit the temporary undervaluation that's being caused by this short-term accounting noise.
The market is treating the diluted GAAP EPS like it's permanent, but we know it's a mix of temporary expansion costs and those non-recurring pre-IPO incentives for top TOY.
So the idea is to go long. You target that 40% return from the consensus price targets, and you're betting on two things normalizing at the same time.
Right. First, that big RMB, 176 million in non-cash equity costs for top TOY. That should phase out over the next few quarters. That will instantly lift the reported adjusted EPS growth.
So the accounting mess gets swept up. What's the second lever?
The top TOY spin-off itself. If that happens, and it unlocks a clear, separated valuation for an asset growing at over 100%, that should reveal a lot of hidden value.
So this is a bet on normalization overcoming the near-term noise.
And it's all backed by that fantastic 1.7x operating cash flow conversion. That financial flexibility is, I think, being widely underestimated. It's a compelling thesis for anyone willing to stomach a bit of volatility.
High growth, incredible cash conversion, temporary margin dip. The setup is definitely there.
It is, for those who can look past the headline attack numbers.
So to recap, we've covered a quarter defined by record revenue, aggressive expansion past 8,000 stores, and of course, the spectacular growth of top TOY.
And while the operational side remains superb, I mean, high single-digit SSSG in China and double digits in the U.S. is amazing, the profitability story is just, it's clouded right now.
Clouded by the margin structure changes and those pre-IPO incentives?
The market is just waiting for stable margin expansion as those international stores mature and hit their peak efficiency.
Okay, so here's a final provocative thought for you to explore as you look towards 2026. The company mentioned that their domestic China franchise base has now surpassed 1,100 partners for the first time. Does the sustained sophistication of that asset-light, stable franchise model act as a necessary counterweight to the more volatile, high-cost international rollout? It's something for you to ponder, that long-term trade-off between margin protection and global brand control.
Thanks for joining us for this deep dive into the numbers.
We'll see you next time.